Markets have done reasonably well actually in the second half of the year, from a period where investors were very concerned in the summer around growth in China, but more importantly around the Eurozone crisis and concerns in Spain, Greece, etc. This started really with the ECB's policy shift, where they outlined a policy in terms of government bond purchases under certain conditions that has certainly done a lot to ease investor fears over a collapse of the Eurozone or the Eurozone crisis. From that point in time, risks or the perception of risks have gradually declined, and risk premia have come down, which means asset prices go up, and other factors have been supportive as well. So we've seen more QE in America. Chinese growth numbers have shown a turnaround from a deceleration to a pickup towards the end of last year. And then in Japan as well, we've seen a more proactive stance from the government there, and hopes that the central bank will be more proactive in terms of generating a higher inflation target, a weaker currency, to try and get that economy moving. So generally we've had a series of positive developments, and at the end of the year there are a lot of concerns around the fiscal cliff in America. The outcome was more or less in line with what most people expected, but in a way that was good news, because the worst case scenario of very, very draconian tax hikes and spending cuts hitting very sharply at the start of the year, that has been avoided, that worst case scenario, and therefore what we have is a moderate fiscal tightening and not a very sharp fiscal tightening. So again, that has been taken well by the market. Ashburton's Multi Asset Funds benefited from the rally in risk assets through the end of the year last year and into the start of this year, in actual fact. Within equities, we had an overweight position in Europe and Asia, which outperformed and worked well for us. In terms of currency exposure, the weakness of sterling of late has helped, given a US dollar position and some exposure towards emerging market currencies for our sterling denominated funds. Within fixed income markets, we continue to have quite a cautious approach with low duration, and the exposure focused on corporate bonds, where spreads have continued to narrow, meaning some modest upside towards the end of the year. We've got a cautiously optimistic outlook for 2013 as a whole. Markets are continuing to climb this wall of worry, if you like, with the various fears, whether it's over Europe, over China, over the fiscal cliff. Gradually we've been overcoming each of these obstacles as we move forwards, and investors have certainly taken a more positive tone in recent weeks. We still think, on a medium-term perspective, that equities offer better value than fixed income, and within currency markets we have a preference for the dollar over the other majors, but more so for various emerging market currencies out there. There's not to say there are no risks left in the world. The policies in Europe are still contingent on governments delivering policies that are acceptable both to their populace and also to wider European authorities and the European Central Bank and EU, etc. Also, there may be concerns on a geopolitical basis as we move through the year, with how Obama will deal with Iran in his second term in office. That is something we think could be quite important. And clearly the world economy has its challenges in a world of deleveraging and a world of austerity, and so we're not completely out of the woods there, but we would adopt a generally cautiously optimistic stance, I think, for this year. Reflecting our view of the outlook for markets over both the short and the medium term, we currently have equity weightings in the multi-asset funds which are slightly above neutral, although not excessively so. On a very short-term view, we do note that there is quite a lot more optimism in the markets today than there was several months ago, which tells you that the pace of returns might not be so sharp in the immediate future. But that is very much a short-term view rather than a medium-term view. Within our equity weightings, we continue to be overweight Europe and Asia currently. where we think there is the greatest upside on a medium-term view. Within fixed income markets, we have very low exposure to government bonds, and our exposure is focused on corporate bonds, although we think the gains in this area are going to be lower going forwards than historically, although modestly positive as we look ahead. As I mentioned, on the currency front, our preference is for a variety of emerging market currencies. And then we think as we increasingly look through this year and perhaps into next year, the dollar might find a firmer footing against some of the other major currencies out there. And therefore, for our sterling and euro funds, we have some US dollar exposure currently.